Hi, this is a quarterly review of the activity in the multi-asset funds covering the third quarter. So looking at the third quarter, you'd think it was quite a quiet quarter. The returns were pretty muted. The growth fund, practically zero return for the quarter. Our cautious fund up about 1%. But underneath, there was quite a bit of volatility. Equities started off very strong, and then towards the end of the quarter, they gave up a lot of that as concern over the election mounted. Fixed income delivered steadily throughout the quarter, slowly compounding as we want that part of the portfolio to do, that ballast that just gives us steady eddy returns, with the equities hopefully doing the hard work over the long term. Looking on to different trades that we've done, so we have been quite active during the quarter. We started off early on in July with a new position in Rightmove, a very strong UK company with a dominant market position, things that we look for. Attractively priced, it had come back for various reasons, that volatility in the market giving us an opportunity to purchase the stocks at a low point and invest some capital, some funds into equities. As we progressed through the quarter, our research led us to become increasingly concerned with the US dollar and how that might affect portfolios with the potential for the US dollar to weaken. So we've taken steps to reduce the dependency we have on earning streams from companies that earn their money from US dollars. We sold out of Fresenius, which, although is a German company, operates pretty much exclusively in the US to US consumers, providing healthcare facilities over there, and exchanged that for Danone, a European company with revenues more broadly derived from European consumers and Asia. Later on, we made another step in that direction. We sold General Dynamics and ExxonMobil. Part of that was to reduce our US dollar exposure, but part of that was also environmental and social and governance concerns. We reinvested the proceeds in a Japanese company called Kao and also Alibaba, so getting emerging market strength and the ability to diversify the earning stream there. So a few changes in the portfolio on the equity side. Fixed income is also an area where we've started to become more active. We've been slowly and steadily reducing our government bond exposure. As many of you will know, interest rates are pegged at zero and yields for government bonds are often negative for many countries, and the UK is no exception. We've been selling down our government bonds and investing in infrastructure, so we added to things like 3i, HICL, Athiona, and we've also been adding to corporate bonds where we can get short-dated corporate bonds and a pickup in yield, so hopefully to enhance the returns there. As we did move towards the end of the quarter, and indeed early on in October, we've seen a pickup in the valuations of a lot of tech companies. You might have heard people talk about tech being in a bubble. We don't necessarily think it's in a bubble, but we definitely reflect the fact that valuations are at the upper end of where they've historically been. And that means it becomes increasingly hard for those tech companies to deliver. Case in point would be Microsoft's results recently, which not only blew out of the park all expectations, but did so in a meaningful way. Yet the shares didn't really react that positively because there's so much priced in already. Over the quarter, we've trimmed Microsoft. We've also cut back our position in Facebook to half of what it used to be. We've trimmed Oracle and we've sold out of Cognizant. So a reasonable step there to reduce the exposure to the more expensive side of technology. But it's not just technology that's going to be expensive as well. Anything that has growth in there, anything where people are sure of the growth, they've just been willing to pay up no matter what the price might be. So unfortunately, as much as we love Ørsted and its unique place in providing renewable wind energy, we had to sell out of that on valuation grounds because the amount of earnings it has to deliver has become increasingly hard for it to justify where its share price is. So we sit back patiently and I'm sure an opportunity will present itself in the coming months or quarters to possibly buy back Ørsted or maybe another company, but time is our ally and patience is often rewarded. So changes at the margin, and all in all, when we look forward to the next quarter, I talked today on the eve of the election, huge uncertainty about what might happen over there. Fiscal policy is all up for debate, tax policy is all up for debate, and we don't quite know how these things are going to shake out, but we've taken the steps that we believe are necessary to put the portfolio in a defensive position beforehand, and as it evolves, we might take advantage of opportunities and pick up some new positions if they present themselves. But all in all, well positioned for Q4.